I'm Mark Dutram with BayView Private Wealth. Today I want to give you an update on how the core investing factors, that's equity, size, value, and profitability, are performing in today's market and what that means for your portfolio. But before we jump into performance, let's start with a simple reminder. What exactly is a factor? A factor is simply a measurable market or company characteristic that has historically helped explain differences in returns over time. So there's decades of academic research that have shown that certain traits, like a company's size, its relative price, or profitability, have consistently influenced long-term outcomes. So instead of trying to predict which individual stocks will win, factor investing systematically tilts towards groups of companies that have historically delivered higher expected returns over time. And at BayView Private Wealth, through dimensional fund advisor ETFs, we structure portfolios around these evidence-based drivers, not headlines, not predictions, but long-term academic research. Now let's look at how those factors are behaving today. So far this year, we've had a meaningful rotation in markets. Russell 1000 value is up over 6%. Russell 1000 growth is down over 5%. So that's 11% differential on those two. Small caps, represented by the Russell 2000, are up more than 6%. And if you look at the S&P, which is roughly flat, and the NASDAQ, which is down, again, we see a pretty significant outperformance in small caps. That's a noticeable shift from the growth-dominated environment we've experienced over the past several years. And we've been kind of beating this drum, right? And we're seeing size and value leadership reemerge. When we look at the style box, small value is leading, as we mentioned. Large growth is negative for the year, and the S&P 500 is relatively flat, which is really, again, a kind of a large cap blend, but it's primarily being driven by those Magnificent Seven stock names. And that's exactly why diversification across styles and market caps really matters. Historically, smaller companies and lower priced value companies have delivered higher long-term returns, right? Again, we're taking more risk there with small companies. But it's not every year, and it's not every cycle. But again, it's consistently over time. If we zoom out globally, and again, we've had, emerging markets and international in the portfolio, value stocks have really outperformed across nearly every major region last quarter. Even after the recent strength, valuation spreads remain historically attractive, especially in the US. So valuations drive expected returns. When companies are priced at a discount relative to fundamentals, long-term opportunity improves. And that's not speculation, that's just math, right? Now let's talk about profitability. And sometimes we refer to that as quality. Last year was one of the most challenging years for high-quality stocks in decades. But historically, when quality has had, an unusually poor year, it has often rebounded strongly over the following next 12 to 24 months. Even more compelling, profitability spreads today are historically attractive. So dimensional kind of integrates profitability directly into portfolio construction because companies with stronger profits and stronger balance sheets have historically delivered higher risk-adjusted returns. And that just makes good intuitive sense, right? We're also seeing concentration risk begin to ease. So only one of those so-called Magnificent Seven stocks is positive this year. And parts of the technology sector have seen a significant pullback. Now, this is a reminder that markets can sometimes become narrow, narratives can really dominate, and crowded trades can reverse quite quickly. So diversification across size and value and profitability and geography is what keeps portfolios resilient, and that's how we try and protect you. Dimensional's philosophy is built on three really key principles, and we always talk about this in our meetings with you guys. Markets incorporate information quickly. They're very efficient. Expected returns are tied to measurable characteristics, right? These factors. And disciplined implementation matters more than prediction. Again, we don't have a crystal ball, and we don't think anybody can have a crystal ball in predicting stocks. So at BayView, we systematically tilt portfolios towards small, value, and profitable companies, and then we diversify globally, we trade efficiently, and we rebalance portfolios with discipline. We don't try to time factor rotations. Many people have asked that question because history shows that you cannot do that. I would love to be able to do that, but we just cannot do it. So we position portfolios toward higher expected returns, and then we allow the markets to do what they do. So right now, we're seeing value outperform growth, small caps outperform large caps, and profitability priced very attractively. And that combination supports diversified factor-tilted portfolios. During our spring reviews, we'll show you how these factor exposures show up in your portfolio specifically. So again, staying disciplined, especially when leadership shifts, is how long-term wealth is built. As always, thank you for your trust that you place in us every day. We appreciate that so much. And thanks for watching another episode of BayView Views.